Welcome to this explainer. Today, we're tearing into the SCHD 2026 Reconstitution, the truth. If you're retired right now or, getting pretty close to it, odds are you hold SCHD in your portfolio. For a decade, it's literally been the absolute gold standard for dividend growth. But as of this morning, the rules have changed. The highly anticipated 2026 Reconstitution is officially here. And guys, this is a complete overhaul of the very companies paying your retirement checks. So let's break down exactly what just happened.
Now, if you've tuned into this explainer, you're probably looking at the massive shifts in your portfolio's underlying assets and asking yourself this exact question. Is my dividend income actually safe? Look, it's completely natural to feel a knot in your stomach when the foundational investments you rely on for your monthly living expenses undergo a major transformation practically overnight. A lot of you are waking up realizing that the companies generating your cash flow have fundamentally changed. But before the panic sets in, we really need to separate emotion from strategy and look at exactly why this happened.
Okay, let's dive into this. There is a whole lot of noise out there right now. You've probably seen the headlines screaming about massive sell-offs and portfolio destruction. Well, we're going to ignore all of that. We're going to focus purely on the cold, hard math behind this massive reset, what I like to call the $100 billion question. Understanding the mechanics of this shift is honestly the only way to truly evaluate whether your retirement strategy is on track, or if you need to make a quick adjustment to steady your nerves and your portfolio. We have to understand the why before we can understand the what.
To really make sense of today's news, we have to talk about the process of reconstitution. Now, SCHD is technically a passive fund, but let me tell you, passive definitely does not mean lazy. This fund is governed by a set of incredibly strict, unforgiving rules. Think of this annual reconstitution as a ruthless spring cleaning. The fund's algorithm? It doesn't care about a company's legacy. It doesn't care about a fancy brand name. It only cares about the numbers. If an asset is underperforming, it gets cut, period. It does this to maintain the overall health and high yield of the portfolio. It's basically a built-in defense mechanism designed to protect your money.
So how does it actually decide? Let's talk about the screening process. The fund basically looks for three main pillars. First off, a company must have 10 consecutive years of dividend payments just to get in the door. Second, it needs a massive fortress-like balance sheet. And third, it has to demonstrate a strong return on equity, or ROE, alongside really robust cash flow. But here is why this 2026 reset is so incredibly dramatic. We're coming off a year where shifting interest rates and the whole AI hype train fundamentally altered the market. Capital rapidly shifted out of traditional value sectors to go chase tech, while competitive pressures totally squeezed legacy margins. The result? Older, traditional companies suddenly saw their return on equity drop, and under the strict rules of this fund, if your ROE drops, you're out. It's really that simple, and it leads to some very painful exits.
Just look at the sheer contrast between the casualties and the new entries. The old guard, we're talking companies like Broadcom and 3M that many investors literally considered untouchable cornerstones of their portfolios. They've been systematically removed. In their place, the fund has rotated in a brand new top 10 list of holdings. And these new entries aren't just, taking up space. Heavy hitters like Hershey and Chevron are the new engine here. These are the specific companies that are going to be responsible for driving your weighted average yield for the next 12 months.
So the crucial point is understanding exactly why those former safe havens had to pack their bags. Let's take a company like 3M, for example. It wasn't a mistake or some weird glitch in the algorithm that removed them. They were cut because their dividend growth started to slow down and they were facing some serious fundamental business challenges. In a high interest rate environment, debt suddenly becomes overwhelmingly expensive to service, which in turn absolutely crushes a company's return on equity. I really want to reassure you here. Seeing familiar, comfortable names leave your fund can feel pretty scary, but cutting these specific companies is a highly necessary protective measure. You absolutely do not want companies with expensive debt and slowing growth dragging down your retirement income.
By cutting that dead weight, the fund aims directly for this target, a 3.5 to 4% yield. And this isn't just some arbitrary number pulled out of thin air. This is the absolute sweet spot for retirement stability. If you're age 60 and above, this is the targeted, growing yield that provides the crucial stability you require. It outpaces average inflation while still allowing those underlying companies to reinvest in their own businesses. The entire purpose of this 2026 Reconstitution is to recalibrate the fund to ensure this specific yield is not only met, but fiercely protected for the coming year.
Now, of course, we have to address the elephant in the room. I know a lot of you are frustrated. You look at the S&P 500, like the VO ETF, and you see it soaring, while SCHD has kind of seemed to lag behind over the last 12 months. And this brilliantly illustrates the difference between chasing growth and securing value. The S&P 500 has been heavily carried by the tech sector and all that AI boom, leading to some historically high valuations. SCHD, on the other hand, is built on a stable yield focus. What you're experiencing isn't underperformance. It's the fund deliberately protecting your capital from overvalued sectors that could correct at literally any moment. That actually brings us right to the core philosophy of this entire explainer, beautifully summarized in this quote. You don't buy SCHD for moonshots, you buy it for the paycheck. If you're out there looking for explosive, unpredictable growth, well, this is just not the asset for you. During this 2026 reconstitution, the fund hasn't drifted from its mission one bit. It has aggressively doubled down on value, cash flow, and stability. It's doing exactly what it was designed to do for investors who rely on a steady, predictable paycheck rather than the anxiety of wild market speculation.
Ultimately, the theme of this year's shift really boils down to cutting the dead weight. This reconstitution proves beyond a shadow of a doubt that the fund's internal mechanics are working flawlessly. It's out there automatically doing the hard, emotional work of selling off degrading assets so that you don't have to. If you rely on a high-share income strategy, this overhaul shouldn't make you nervous at all. It should honestly make you even more confident. The underlying health of your portfolio has essentially been restored and optimized for our current economic reality.
All right, let's turn all this information into action. Here is your Reconstitution action plan. Number 1, do not panic sell. I repeat, do not panic sell. The shift in holdings is healthy. Number 2, decide if you're reinvesting your dividends right now or taking them as cash, because the new yield is going to impact that math. And number 3, check your overall portfolio balance. If SCHD is your only holding, you are absolutely going to feel the specific volatility of the value sector. Ensure you have the right total portfolio exposure so that you're insulated from any single sector's wild movements.
Which leaves us with the ultimate question to consider today. Are you sticking with the new SCHD, or has this shift made you want to move over to a broader growth index like VOO? The central conflict of today's market is choosing between the allure of tech-driven capital appreciation and the rock-solid security of a retirement income engine. The 2026 reconstitution proves that SCHD remains the reigning king of the latter. I invite you to evaluate your own strategy, take a hard look at your timeline, and decide which path secures your financial peace of mind. Thank you so much for joining me for this explainer, and keep learning.